So good afternoon, everyone, and thank you for joining us. I'm Sabine from the AASB, and I would like to welcome you to the dialogue series. So the dialogue series is held jointly with CPA and CAA and SET. Please note that the views shared in these sessions are not the views of the presenters' organizations, but their personal views. And we will record this session and it will be made available on the AASB website. So today's topic is segment reporting, operating segment reporting, which is possibly a bit of an underappreciated area. It doesn't seem to come up in discussion often, even among accountants. But the International Accounting Standards Board has listed operating segments to the reserve list for potential future improvement in its third agenda consultation. So it was put on the reserve list because users highlighted operating segments as a high priority topic, but it wasn't a high priority for preparers, which in itself is quite interesting. So today, we would like to shed some light on the Australian segment and segment-like reporting landscape, including from the not-for-profit, private and public sector perspectives. And first, we will hear from Dr. Eka Tan, who is involved in a joint research project between CPA Australia, the Malaysian Accounting Standards Board, and the Australian Accounting Standards Board on this topic. Eka is a lecturer at Deakin University with a research focus on corporate governance and sustainability. He has an interest in financial statement disclosures, including the ongoing exploration of segment reporting. Eka has also actively contributed to research projects with the AASB and is a member of Deakin Business Value Creation Centre. So the research presented today is part of the AASB Research Report number 24 and MASB Research Report number 3, addressing key accounting challenges, and it's published on the AASB website, so please do and go and have a look. After Eka's presentation, we will be joined by our highly experienced panel, and they will bring their perspectives and insights into the discussion. As usual, we will then be followed by an audience question and answer session. So I would really like to warmly invite our audience to participate in the discussion and use the Q&A function. And we will do our best to address these questions either throughout the session or at the end. And now I would like to hand over to Eka. Eka, the floor is yours. Thank you.
Thanks, Sabine. Just checking if you can see my slides. Yeah, okay. Thank you, Sabine. So yes, hi everyone. So my name is Eka. This is a project that as Sabine mentions earlier, collaborations between AASB, MASB, and CPA Australia, looking at the IFRS 8 operating segment implementations. So the overall research questions that we are trying to look at in this research project is how and to what extent is segment-related information being presented in the notes to financial statement of listed entities. Okay, so if we look back into the IFRS 8 in general, we can see that the definitions of operating segments is a component of an entity that engage in the business activity that may earn revenue and incur expenses. It must be regularly reviewed by the entity's chief of decision maker, CODM, and also it must have discrete financial information that is available. If we move on to the disclosure requirement, there's these three things being mentioned. So in terms of the general information, it talks about how the segment is being identified, what is the basis of the organizations, the types of product services that need to be provided. And then we also have specific financial information for each reportable segment, which I will mention what are the requirements in next slide, as well as the entity-wide disclosures that cover the revenue from the external customers from each product and services, as well as geographic areas, as well as the information on major customer. So when we look at the measurement requirements, these are the items that I've identified from the IFRS 8. So on paragraph 25, we can see that there's a mentions of segment profit or loss, as well as segment asset and liability. And we also have explanations on the of the measurements, how the measurements of each reportable segment, and it need to explain any differences between these internal measures and the consolidated IFRS measures in reconciliations. And last but not least, there we have IFRS 8, paragraph 28, where it's required to have a reconciliations with the amount reported in the consolidated financial statement. So based on these informations or disclosures requirements from IFRS 8, we identified this as our research method. So because this is a collaboration between MASB and AASB, so we look at 50 ASX listed entities, so the top 50 based on market capitalizations in ASX as well as Bursa Malaysia. So we have a quite sample size of around 100 entities. The details that we collect are based on the measurement requirements as well as the disclosure requirements. So it covered things like the number of reportable segment, what are the type of each segment, what is the basis of segmentations, the financial item disclosed for each segment, explanations of how segment profit is being measured, as well as the identifications of CODM and how the role is of CODM in the entity. What we found, based on the industries, we try to look at the industry in general, just because in the different industry may have different way of categorizing things. So if we look at the overall, the majorities come from the financials, which is pushed up by the Malaysian entities. There are 10 of Malaysian entities within that financials industry. But following to that, we have industrials. And if we see the distributions, they are quite balance across different industry sectors. In Australia, for example, we have materials and information technologies that is not covered in Malaysia, but in Malaysia, we also have very highs in terms of the communication services as well as consumer staples. So we can see that the good distributions across different industries. In terms of the number of segments, so there are only 9 entities with single segments, but other than that, we have 91 entities with multiple segments. And if we look at the number of segments within each entities, they are ranging from 2 to 12 segments. And we can see that on average, there are about 4 to 5 segments per entities. That's the same for Australia and Malaysia, although we can see that the mean for Australia is slightly lower than the Malaysia. And then we also look at how the segments are being categorized by the entities. Just to be clear, most of these categorizations are implied by the researchers. So a team of researchers identify how it's being categorized, because what we found is there are many of the companies that do not disclose what are the basis for their categorizations. They just mentions the segments, but they don't specify the segmentations categories. Okay, so if we look at this chart, we can see is that most of the time it's being categorized based on product and services. In this case, there are 63% of company that look at by using product and services, followed by geographical, which is 24% and 24 entities, as well as 13 entities categorizing by customers. Even though if we see here in categorizations based on geographical, there are only 24, but in additions to that, there are 49 entities that also disclose geographical segmentations on top of the product or services as well as customers. So in total, there are 73 entities that disclose the geographical segmentations on top of what the general segmentations has been implemented for the reporting. And then we look at the top 5 reported items. Of course, there are different items, line items being reported in regards to segment performance. So what we identified is most of the time there are 95 entities that disclose about the operating revenue, and the other things that is consistently appear is the depreciations and amortizations across both countries, Australia and Malaysia. But other than that, we can see that in Australia, there's a lot more disclosures about EBITDA and net profit. And when we look at the Malaysia entities, we have share of profit from equity as well as intersegment revenue. So we can see here there's slightly difference in terms of what mostly being disclosed by entities across countries. In terms of CODM, we can see here overall there are still a lot of entities that do not disclose who are the CODMs. It could be combinations of different roles. It could be CEO, board, or executive. If we look Australia, the most common way of categorizations, the identifications of CODM, most of them are the CEO, so the single role. While in Malaysia, we can see is that the board plays a bigger roles here, so they are more likely to be the CODM for being reported there. So we can see that probably the corporate governance of the characteristic of the countries influence here, where in Australia, most of the time it's the CEO, while in Malaysia, the board play a more prominent roles there, more group or bigger consolidated discussions being implemented there. Okay, but overall, if we look there, overall, the most common CODM is the CEO. And then looking at the economic indicators, the three most common economic indicators, including profit, EBITDA, and EBIT. So if we look at them as bigger categories, most of them are the profit. So profit-related measures being used as the economic indicator, which is not surprising, given that that is one of the way of or items that need to be disclosed when it comes to segmental reporting. But also we also identify there's a sales being implemented by 7 entities. But what's surprising is there are still 46 entities that have not disclosed what is the performance measurement being used when it comes to segmental reporting. So if I can give you some examples of what are a good good disclosure when it comes to segmental reporting. This is one of the company Goodman from Australia. So they identify who are the CODM, who is the CODM, what are the descriptions of segmentations, how they are being segmented, as well they give descriptions of what are the performance indicator being used. Same thing with these companies from Malaysia, so the Genting Berhad. They disclose who is this CODM, what is the descriptions of the segmentations, and what is performance measurements on top of the disclosure of line item per segments. So some key takeaways that we have summarized here is there are different approaches being adopted by entities when it comes to how they segment their segmentation. They do their segmentations, but as I disclosed earlier, only a minority of samples that have explicitly disclosed their basis for segmentations. So IFRS 8 paragraph 22 in particular should be reinforced. So maybe this can be something being considered, being explicitly disclosed when it comes to how it's being the segmentations is being done. The second one is the diverse disclosures. So it's if you look at the different segmentation, the line item for different segments in the notes to financial statement, you can see that there are different line items being disclosed. So one of the suggestions that we have provided is AASB could consider recommending certain minimum performance metrics that can be implemented across different entities. So metrics like revenue, profit, asset, and liability can be considered as the minimum. So it's being disclosed by all different entities. Next one is the CODM, the Chief Operating Decision Maker and Segment Performance Indicator. They are not widely disclosed, so many entities do not specify this, and probably IASB can recommend the disclosures of this CODM and how they are using these performance indicators to assess the segment performance. Last but not least, one of the recommendations that we also presented in the report is maybe these segmental informations could be integrated into other segments in the annual report, such as the management commentary, so it can enhance the connected informations between segmental reporting and the broader performance of the company. That's all from me. I return the floor to you, Sabine. Thank you.
Thank you very much, Eka. So thank you very much for this very interesting research and the recommendations for the standard setters to consider. And I would like to throw some of these findings back to our panel. So before doing so, I would like to introduce our panel. We have Dean Allen, who is IFRS and Corporate Reporting Partner at BDO. Dean previously worked at Pitcher Partners, Moore Stevens, APRA, and the AASB, and he has been a member of the AASB's Disclosure Initiative Project Advisory Panel and Financial Instruments Panel. Dean is a member of CPA and AANZ and will present his views from a preparer's perspective, in particular from a private not-for-profit sector point of view. And many of you already know Amir Ganda, who has been in previous panels on the dialogue series. Amir is CAANZ's reporting and insurance leader and brings also preparer's lens to the discussion. Next, we have Siva Sivanantham, the director of the Accounting Policy Group at the Department of Treasury and Finance, Victoria. Siva has 20 years of experience in accounting standard setting and their application, having previously worked at the Victorian Auditor General's Office, Grant Thornton, Maud Stevens, EY, and the AASB. Siva is also a member of CAANZ and a fellow of CPA Australia, and will speak from a public sector not-for-profit perspective. Then we have Anne Waters, the Director National at the Auditing and Assurance Standards Board. And prior to joining the AASB, Anne worked at KPMG and the Department of Professional Practice, and is a fellow of CAANZ. And will bring, of course, her audit perspective. And last but not least, we are joined by David Wilson, who is Deputy Head of Australian Equities Growth at First Sentier Investors. And David's previous roles include managing the equities research, sales and family office business at UBS and at JP Morgan Minute. And David will share his analysis and reflections drawing on his experience as an investor. So to start off the panel discussion, I would like to first hear maybe David's thought on our findings from the research. Are operating segment disclosures something that is important to users? And if so, which aspects are particularly relevant?
Right. No, well, thank you, Sabine, for the question, and thank you, Eka, for your work. What I would say about segmental reporting, and this is from both the sell side, because as has been said, I was for many years an analyst at JP Morgan, and I ran research at both UBS and JP Morgan, but I can also talk from the buy side as both an analyst and also as a portfolio manager. And it's safe to say that we view segmental reporting as actually very important, quite crucially important. And so some of the things we think about, and it does go to the cost of capital of a particular company, is we don't like frequent sort of resegmentation, so frequent changes. We don't like that. And if there is a change, whether it's by the company or it's created by version of something like AASB 16 changes, then we think best practice, and I'll sort of cite a company like Dyno Nobel in Australia, they did 5 years of back history. A lot of companies might only do 1 or 2. Dyno, to their credit, did 5 years of back history of segmental reporting, from the operating revenue line through the EBITDA line, through the D&A line, down to EBIT. The other area that we think is important is that it's actually done to the EBITA line in Australia. So we want companies to do it on an underlying basis, and so therefore exclude write-downs, exclude acquired intangible amortization, and also sort of flag the equity accounting component as well. I think we're not naive. We have to appreciate there are sometimes commercial sensitivities when companies are competing against private companies or international companies. There may be a commercial sensitivity. And we also do understand that sometimes companies do arbitrage segmental accounting, so where they cost shift out of a sort of, if you like, a low PE or low multiple segment into a higher PE segment. We're aware of that. We're also aware we don't like large unallocated items as well. And we also note Eka's work around whether it's, whether you should do it, whether companies are doing it on an industry basis or geographic basis. We don't mind either way. It really depends on how the company is run. And but we just want consistency and not frequent changes. So that's that's how we'd summarise. But the most important line, I would say, is that it's done. It may be done at the EBITDA line, but as long as you can get to the EBITA line, which some companies in Australia don't do, if you can get to that underlying EBITA line, that is the key line that we're looking for segmental reporting alongside operating revenues without a large unallocated item. That's how I would put it, Sabine. So I hope that's helpful.
Yeah, thank you, David. One thing that you mentioned was that you would like to have the full segment disclosures, right? In the standard, they require 75%, and then the headquarter costs are kind of something that is not a segment, right?
Yep. Yeah, we understand that, and so therefore, if there's head office costs, so be it. And yeah, if it's, I mean, 25% is high. We'd like to see it sort of probably more like 10%, but sometimes that happens. So we're aware of it. Again, as long as it's done consistently. But and I know that companies often hide costs in there or hide revenues in there for commercial reasons as well. But we just need a sort of consistency of segmentation is the other key sort of point that we push.
Yeah. And another one of the findings that came out of ECA or the joint research report was the non-disclosures about the CODM. Is that something that you are concerned about, or?
Not really. I mean, we sort of take it as a given that the CEO and the CFO own it. I guess if we have an issue around segmental reporting, we will most likely take that up. In Australia, obviously I can't talk to Malaysia, but in Australia, we would view that as an issue we would address with the CFO.
Yeah. Another area that has recently sort of come into play was AASB 15, revenues from contracts with customers. And that standard also requires disaggregated disclosures from those revenues. Is that something that you find helpful, or?
It's helpful, but really we're really sort of trying to get to, yes, I understand you can have royalties. So we'd probably prefer it just from customers, and so having the revenue line, if you like, at the operating revenue, so the sales to customers, rather than including royalties or interest income, because we don't want that line to be a mixture of apples and oranges, but nor do we want it to be apples, oranges, and staplers. So so therefore, yeah, we'd like a consistency, but we understand that there are companies with large sort of franchise businesses or whatever that they're going to have those other components in there. If that's in it, so be it. We're not sort of have a hard and fast rule on that particular point.
And another topic that you mentioned was commercial sensitivity. Now, the standard actually does not have exemption for commercial sensitivity, but you kind of assume that sometimes companies do not make disclosures due to that.
All they will disclose, sometimes they'll just do one segment, or if they do it, they might do 2 or 3 segments, but then they will shift costs or revenues into the unallocated lines. I'm not going to say them on the call. I'm aware of companies doing that, and to be honest, I understand it, but therefore it's even more important that all the numbers add up to a particular EBITA line, and that is done consistently.
Yeah. Thank you, David. So then I might maybe move on the conversation to the preparers. Amir, do you know some of the challenges, or are you aware of some challenges that preparers are facing in the operating segment disclosures?
Sure, Sabine, and I think at a very high level, or in a nutshell, these do overlap with the kinds of things David was talking about, and if maybe just to add on to the end, I think what we hear also from investors, including through our research with retail investors, is going back to that those kinds of challenges that David talked about, and I think what sort of unites those with the challenges preparers face is the focus of the CODM model, and the fact that what is useful information for a chief operating decision maker is not necessarily the most useful information for investors in all cases. And then we have to remember that investors are now a very broad and diverse group, and increasingly so. Therein lies the challenges. So if you think about the preparers, identifying the CODM is, of course, really a critical part of this, and can be challenging. It can be ambiguous, and I think that does come out a little bit in the research that Dr. Tan was talking about, especially in a matrix style organizations. The way we do organize ourselves now, and the way technology's impacted on the way companies are structured, means that you probably there's a trend towards flat structures and ways of operating that don't neatly fit into the concept of a CODM model that effectively assumes that approach is going to create the information that both is workable and makes the most sense from a preparer perspective, or is going to be the most useful for investors. The changes, and this is not necessarily just for the purpose of the information presented, but internal restructuring, of course, can result and trigger changes to the reporting. And companies do tend to, do a fair bit of that these days, also depending on the conditions. And as David mentioned, investors don't like that. And I think it's fair, that's quite fair, because it means that trend analysis becomes very difficult if it's changing every few years. One of the key things in analysis is in comparisons over time, not just against peers or between different segments, and that can be very, very difficult if it keeps on changing. And once again, it comes back to that quite flexible approach, which has its advantages, but of course these are some of the challenges and cons that come up. Allocating the costs across the segments, of course, once you've worked out what they are and the approach, can be very complex in some cases, and it can become very subjective, and that can impact on consistency. So I think for preparers, and this probably also goes over into auditors trying to challenge how that's been done, it can be a bit of a quite a complex and challenging picture to unpack. Lots of spreadsheets, which of course we love, but so long as they all reconcile at the end of the day, and they don't always, even by the time it gets into the final report. And finally, of course, those commercial sensitivity concerns are an issue from the preparer perspective. And as you mentioned, Sabine, there's not really an official out for commercial sensitivities, but the model is so flexible that it would be very surprising if a company didn't adjust how they're doing the CODM reporting in order to avoid revealing highly sensitive and problematic commercial information. So therein lies an issue for investors, preparers, and auditors, and from an overall integrity perspective in the reporting. But I think trying to make some of those calls, if you think about it just from the perspective of the average CFO, or even the folks working, chartered accountants working in the finance team, that's a pretty hard one, working out how to navigate some of those sorts of issues, and then the sort of liaison that's needed throughout organizations in order to make that work. That's a fair bit of time and effort. So certainly adds to the overall difficulty of doing segment reporting from the perspective of the preparers.
Thank you, Amir. Some very interesting points, and I see Anne, you already are ready to go. And thanks for that segue, Amir, into the audit realm. So Anne, what are some of the challenges that the auditors may be facing?
Thanks, Sabine, and thanks everyone. Well, I must admit, when I was asked to participate on this panel, I said to the AASB, it's not an area that is raised with us. It's not an area that auditors have raised concerns. It's not an area that I'm aware of regulators raising concerns around the auditor's role. They may have some concerns about some reporting at times, I'm not quite sure. But the more that you think about segment reporting and the auditing of that information, it is challenging for auditors. We've heard a lot about the flexibility in the reporting requirements. The auditor signs off that the financial report, which includes your segment reporting, has been prepared in accordance with the financial reporting framework, so the accounting standards. So the less prescriptive and more flexibility there is in accounting standards, it is more difficult for auditors to challenge what is being reported. So they obviously will need to look at the internal reporting that is happening by the entity to make sure that that is how they're determining their segments and the amount of information that they are reporting. But as we've heard, there's a lot of flexibility around the amount of information they can report. And it's difficult for auditors to challenge that when the accounting standard doesn't require specific things. So I think that's probably the biggest challenge for auditors. And so then there needs to be a discussion around whether the level of flexibility in the reporting requirements is creating undue inconsistencies, which isn't good for users. So it really depends, because we all know that you don't want highly prescriptive, because people need to flex to what is useful to the users of that information, but then the auditors need sufficient rules, I suppose, that they can challenge management when they don't think the disclosures are helpful or in accordance with the reporting requirements. So I think that's probably the main challenge for auditors in this space.
Thank you, Anne. So I think, as you mentioned, it kind of also comes back to how familiar the auditors are with the entity and doing their job, in familiarizing themselves with the whole entity and not just one part of an entity.
Oh, absolutely. So they would always step back and make a judgment, and using their professional judgments, whether they think the disclosures are overall materially correct. But that is then obviously based on the internal reporting.
Yep.
Because that's what the standard is pinned on. Yeah.
Yes. Yeah. Thank you very much. So now we've spoken about the for-profit sector a fair bit. In Australia, we have obviously a sector-neutral approach, theoretically, but in the operating segments, or in the segment-like reporting realm, it is a bit different. So AASB 8 operating segments does not apply in the not-for-profit sector, and that includes the public and the private not-for-profit sector. So, Dean, you've been working with private sector not-for-profit entities for a while, and if I may play devil's advocate here, do you think that segment disclosures or segment-like disclosures would provide useful information to users of the private not-for-profit sector?
Thanks, Sabine. I'm not sure. The question around not-for-profits actually providing disaggregated information is an interesting one, because they're not actually required to do it. But we do see relatively regularly, we do see not-for-profits actually including sort of disaggregated information in their financials. Often it's based on their projects, or what management identifies as sort of their key obligation areas, or the key sort of strategic areas that they're sort of working to. There's always a bit of a danger that they sort of creep into the for-profit world by actually calling these disclosures operating segments and segment information, which you have to sort of remind them that if you do start calling it segment information, you're going to be compelled to actually do the to comply with the standard, particularly if you're preparing general purpose. So, but it's interesting that you do see it almost voluntarily, relatively regularly. So that indicates to me it could be one or two things. It could be or both. It could be that users do find that information useful, that some of their stakeholders are asking them to give them particularly information about sort of their programs on a more granular level. But it also, I think, in part, it probably reflects a very a more governance mindset, or not maybe more, but particularly a governance mindset that you often find in not-for-profits, where they feel like they are compelled to provide extra information, and so by preparing sort of disaggregated information, they like to demonstrate that governance sort of mindset by doing that. Whether that means that users would benefit from that information, I'm not sure. I mean, at the moment, the AASB is obviously doing a project around general purpose financial reporting for not-for-profits, so something might come out of that. We're not necessarily seeing a great, because these disclosures are not compulsory, then we don't necessarily see it as there's a compliance or necessarily a consistency issue. But perhaps going forward, if this type of information becomes more prevalent and maybe users regard it as useful for their decision making, maybe there might be some impetus for the standard setters to look at it as a way of maybe giving some guidance, maybe in the first step, to help not-for-profits, because as much as they like to call operating segments, sometimes they call those disclosures operating segments, they actually can't really apply the standard, because often these programs don't have separate revenues of their own, so they can't really apply the definition consistently. They sort of have to adapt it to their own circumstances.
Well, thank you very much, Dean. That's very informative. And as you point out, there are differences in the not-for-profit space that would probably require that the standard setters, if they do look at something like segment reporting in that area, it would really have to be a comprehensive review. But noting that maybe there is some value in that information, but yeah, it might not be on the highest priority for everybody involved at this stage. But in the public sector, it looks quite different. So even though AASB 8 does not apply to public not-for-profit sector entities, either, there is quite an amount of disaggregated information in the public sector. And just to for those of in our audience that are not so familiar with public sector requirements, we have AASB 1052 disaggregated disclosures, which applies to government departments and local governments. So for local governments, AASB 1052 requires disclosure of the carrying amount of assets, income, and expenses for each function or activity. And for government departments, it requires those disclosures by activity. And then we also have our consolidated financial statements, which are subject to AASB 1049, whole of government and general government sector financial reporting, which requires the disclosure of assets and expenses by function, which is essentially determined by the Government Finance Statistics Manual. And functions can be something like, health or education. That would constitute a function in that context. So, Siva, what are your reflections on the current state of segment-like reporting, public sector?
Thank you, Sabine, and good afternoon, everyone. As you pointed out, Sabine, AASB 18 segment reporting only applies to the for-profit entities, in particular the listed entities. What we do in the not-for-profit public sector is what we call segment-like reporting, as you pointed out, and the idea is to provide more meaningful disclosures within the public sector context. I think it's really important to contextualize this sort of disclosures within the public sector in the first place. And I can only reflect from the Victorian public sector perspective, since my experience there. If you look at the Victorian public sector, for example, what you have is one entity, and that is the Crown, the state of Victoria. And there are departments and agencies which are effectively administrative units of the Crown or segment in some way. What we currently do is full general purpose financial reports by all these departments and agencies. So that is the sort of reporting that we already do, although these are effectively segments of the state of Victoria. And I think it's really important also to point out that if somebody really wants to understand the performance of the Victorian government, for example, they would be looking at the whole of state financial report, because that is the one that will provide that meaningful information in terms of how the government performs. Because what you see in the departmental and agency financial reports would provide limited insights, because it is effectively a segment of the government in some way. So I think that context is really important. If you look at what we already report in an actual reporting sense, I think we already do quite a level of reporting. As I already mentioned, we do agency level financial reports, department level financial reports. We do sectorial reporting, and that is general government sector, public financial corporation, public non-financial corporations, etc. So that bucket level, at that level. And then we do the whole of state reporting at the highest level. So there is already a lot of reporting happening. On top of that, we also do the estimated financial statements as part of the budget process. And that also goes through an assurance review by the Auditor General as part of the process. And as part of that disclosure also, we provide the budget year reporting as well as 3 forward years in terms of, the portfolio, sectorial, as well as the whole of state finances in terms of where things are. So my point there is that we already do quite a lot of reporting. So my question would be, are we actually over-reporting in some sense? Yes, all this reporting is good. We want to be accountable and transparent, but are we actually reporting in a way that is useful to the readers? For example, if you look at our departmental and agency financial reports, who are the readers? Are we providing the information that they really need, and are we providing that effectively? I think that's a real question to me. So before we add anything more, we would want to understand what is the problem that we are trying to fix here.
Yes, Siva, thank you. Very good point. And as we know, it is notoriously difficult to really pin down the users, right, in the public and also in the not-for-profit sector. But of course, it should be the question that should be asked in the first place. So IPSAS 18, which is the standard international public sector accounting standard, IPSAS 18 segment reporting does require the disclosure of disaggregated information for revenue, expenses, liabilities, and assets. And but in the AASB work program, they have indicated that might be an area that they would like to look at. And some of the stakeholders have said that that standard is a bit difficult to apply. And for example, New Zealand has not adopted that standard. So likely the AASB would look at IFRS 8, which is the for-profit standard to start with, at least, as a starting point. So do you think, for example, something like the CODM approach would work in a public sector context?
Good question, Sabine. I think it would obviously require detailed consideration and sector outreach in terms of whether that would work in the sector. But my reflection is that we will have challenges in applying it for a number of reasons. As I pointed out early on, the dynamics of the public sector is quite different to a listed entity. And our funding and financing arrangements are quite different to how a listed entity would typically operate. The way we operate is what we call the purchaser provider model, whereby, for example, if you look in the Victorian government context again, it is the Minister for Finance purchasing goods and services from departments and agencies. and we do the funding. In other words, there is, we provide the funding in the form of appropriation for specified goods and services, and there's an accrual process then to certify revenue in some way, whether they've actually achieved those goods and services and what is the revenue they are entitled. So that is sort of the model in which we operate in terms of the departments and agencies. And you will find that a lot of the policies are centrally driven by the central agencies and cabinet in terms of, what we want to achieve. Similarly, finance policies are also, centrally driven. We operate under a devolved governance model. There is, finance responsibility and accountability at the departmental and agency level, and there is also that close linkage with the central agencies, because we provide funding for a specific purpose. And entities can only use the funding for that specific purpose. And if they want to reallocate resources, then they need to come back to central agencies and ask for permission for the resource to be reprioritized. So when you look at it, a lot of the decision makers often don't have the same ultimate authority in terms of resource allocation, monitoring performance, etc., compared to a for-profit environment. And that partly reflects the way in which we operate. So we, for example, on concepts like CODM, in terms of who is the chief operating decision maker, we might need some additional guidance, and there might be challenges around it. And again, I think the key question would be, just repeating what I already said, what is the problem that we are trying to address if we want to roll it in a public sector context?
Yeah. Thank you, Siva. So to summarize, so these segment disclosures in the public sector, they haven't really been reviewed for a very long time. Do you think that there is a case at all? I know you said, what is the problem here to solve, but do you think there is a case for some kind of review in this area?
I think it would definitely be beneficial to review, Sabine. But if you ask me whether this is a priority, I would personally say no. I would say other projects, such as, say, the post-implementation review of the service concession requirements, or even the public sector framework project, potentially looking at a tier 3, that sort of projects would be much more higher priority than this one.
All right, thank you. So I think we're getting a bit of a theme here in the not-for-profit sector. Okay, so finally, before we go, maybe then in the Q&A session, any concluding comments from the panel? Is there anything, for example, from David? Is there any information that you would like to see, since this is really a user-driven standard? Is there anything that is not there currently that?
Yeah, I mean, just on that point, Sabine, our preference, and I think I mentioned underlying EBITDA, and I mean, we think the whole P&L should be structured around underlying NPATA. So, excluding acquired intangible amortization after tax, and with the sort of tax allocated, and also with sort of one-offs, so abnormal items, significant items, whatever you want to call them, as well, removed as well. So, we spent too long trying to sort of separate reported NPAT from underlying NPATA, and that needs to be built down. Generally it is, but generally that needs to be built down from the underlying EBITDA line at the segmental line.
And Amir, do you have any concluding comments?
Yeah, just in terms of some things that I would see as possibly opportunities for improvement by standard setters. So firstly, with the model we have now, just clarifying the way that CODM model applies, and really guidance, possibly some more indicators such as executive compensation, capital allocation, or board level oversight, and just expanding on some of those concepts would probably help both the preparers and the auditors. Secondly, enhancing the disclosures in the way that David's talking about the EBITA point, but also beyond that, more granular disclosures in terms of the segment performance metrics. So there's an opportunity to improve those, and the reconciliation requirements between the segment and the entity level data. Thirdly, requiring, of course, this goes back to another point David raised, the multi-year comparative data. So mandating to an extent multi-year comparatives, particularly depending on the changes where things have been resegmented or restructured, would be useful. Addressing, look, I think to conclude, maybe also looking. I'm always one to encourage blue sky and open-minded thinking, and I do think that there's a genuine case for going back to the model and looking at some of the other alternative approaches. The CODM model is very much a product of decision making that's highly sector neutral, of course, within international standard setting. Is there a case for exploring some other hybrid models that combine CODM with other factors touching on investor relevance or other decision making reference points, or also those models other than the CODM that actually prioritize user needs over those internal management views. This could seem prescriptive, but also there are other approaches out there based on business structure or geography and other touch points, product lines that can help. I do acknowledge though two things. One, it does seem like this is working. All of the feedback, although there's lots of challenges, the overall message from users, preparers, and auditors is that we are able to make this work, and there aren't huge complaints about where it's at. So I'm really suggesting those ideas as things for consideration, as if the AASB and the AASB, of course, are having a look at this. But of course, it is important to weigh up the pros and cons, and also the fact that to get maybe a more extensive and comprehensive sense of what the stakeholders, investors, and others are sort of experiencing before making any big changes.
Thank you very much, Amir. All very valid points. Sorry, Anne, from an audit perspective, any final comments?
No, not really. I mean, I do agree with what Amir was saying, and maybe a little bit more granularity or guidance or requirements around what the minimum level of disclosure is, minimum level of detail. So then auditors have a little bit more to challenge management if they don't think that they're meeting that. Otherwise, I agree with what Amir was saying. Thank you.
Thank you. I think that that feedback about the going back, a consistency over time when there are changes, I think that was something that the AASB has already heard before. And back then they kind of decided that it might be potentially too onerous. But it might be, if that is something that is important to investors, it might be something for standard setters to reconsider, especially as we just discussed before the meeting, that might have a real impact on the cost of capital for these entities, right? David, and we've confirmed that also. Eka, you found a research paper that showed that companies, the operating segment disclosures, the quality of them does have a real impact on the cost of capital. Now, we did have a question about non-compliance. What do you do? So, David, or when you do observe non-compliance in financial statements, do we report this?
I can answer this, but someone else is probably in a better position to answer it than me. But from a user point of view, what I would say is that if we see non-compliance, we wouldn't raise it with an ASIC or a regulator. We would bring it up with this, the company and the board, rather than, because we don't want to get regulators unnecessarily involved. So that's how we would deal with it. But there's probably others who've got more, sort of probably more important insight than me.
And researchers.
I think this question probably is directed to me, Sabine. So when it comes to the research report, I think the idea of our research is to look at how is the textual analysis in terms of the extent towards the extent of disclosure. So I don't think that is the idea of like analyzing and reporting to the ASICs. That we just want to look at to what extent is the disclosure at the moment. But the main things that probably I would pinpoint in this case is we want to make sure that what is being disclosed at the management's commentary or the OFR is aligned with what is being disclosed in the financial statement. But to answer that question, I don't think that we are going towards that direction.
Yes. And really what our research shows, and also what I think is confirmed in this panel discussion, is that the companies themselves should have a real incentive to report best practice. And I think that is something for entities to keep in mind, that even if we do not have specific prescriptive requirements in the standard, that there is still this incentive for entities to improve their reporting based on their own best intentions. Okay, so if are there any further comments or questions from the audience? If there aren't any, then I would probably conclude this dialogue series. So, and to summarize, we've heard that yes, there might be room for improvements in segment reporting and segment-like reporting, such as minimum disaggregated disclosures, or further information about the CODM. But there might be also other priorities, especially in the public and private not-for-profit sectors. So I would like to really thank the panel and the presenter, Dr. Eka Tan, Anne Waters, Amir Ganda, David Wilson, Dean Arden, and Siva Sivananthan for their valuable insights and the time. And of course, I would also like to thank our audience. Please don't hesitate to contact us for any questions or comments you may have on this topic, and also suggestions for future dialogue series. The dialogue series will be available online in a few weeks. Please check it out and forward it to anyone that you think you might be of interest to. All right, thank you very much, everybody, and have a good evening.
Thank you, Sabine.